Cost of Capital, Chapter 11. Continuing on from Part 2 into Part 3. Cost of capital for increasing amounts of financing. So the higher cost after tax is 8.6%. Weight is 30%. The weighted cost is 2.58%. And see the calculated examples there. As I said in the course, we won't use preferred stock, but this is how you would weight it if we were doing it. Amount of financing for marginal cost of capital is shown for 0 to 39 million, and the percentage is shown there on the right hand side. Again, the marginal cost of capital we show increased 2.77, then 11.23, showing the marginal cost of the increase. Cost of debt, cost of preferred stock, cost of common equity, and the cost of new common stock. Don't be alarmed with the cost of the preferred stock and the cost associated with that. We will not be using this in this course for the simple calculation that we'll be doing for the case study. Performance of PAI and the market. And you can also use that for linear regression of returns between them. It says the CAPIT is an exceptional model and there is no guarantee historical data will reoccur. One area of empirical testing involves the stability and predictability of the beta coefficient based on historical data. And there would be your example that would show it larged if you wanted to look at that. Do not be alarmed by this. It will be broken down in the case study, showing the video next week for that. For your problems, they're going to be simple as well. Security market line. Under CAPM model, an investor is expected to achieve an extra return above the attainable from a riskless asset in order to induce the assumption of more risk. Security market line identifies the risk-return trade-off of any common stock asset relative to the company's beta. That's all you will need to know in this course regarding what this is. You can see the required rates of return in different lines associated with that. When interest rates increase from the initial period, security market line in the next period is parallel but higher. This indicates that required rates of returns have risen for every level of risk, as investors desire to maintain their risk premium over the risk-free rate. An upward shift in the SML indicates that the prices of all assets will shift downward as interest rates move up. As investors become more pessimistic about the economy, they require larger premiums for assuming risks. Rising interest rates and pessimistic investors go hand in hand, so the SML may change its slope and intercept at the same time. This combined effect would cause severe drops in the price of risky assets and much larger required rates of return for such assets. End of Part 3.